Friday for the monetary policy announcement without much clarity on the political color in Delhi or, how the budget and the ecosystem will pan out. CNBC TV 18 Citizens Monetary Policy Committee is meeting, as always, to discuss what the Reserve Bank will think about, what it should and will do in the Friday statement. Let me welcome Chairman of the CNBC TV 18 Citizens Committee, Dr. Pronab Sen, and members Samiran Chakrabarty of Citi, Sonal Varma of Nomura, Sajjid Chinoy of JPM, and Soumyopkanti Ghosh of State Bank. Gentlemen and Sonal, thank you very much indeed for your time. Well, first up, let me start with the Chairman. Dr. Sen, how should the Reserve Bank and the MPC think about policy when you're not sure about the political setup?
Well, I think there's a certain amount of assurance about the political setup. The question, I think that's the big question. Had this been a situation where there was uncertainty about government formation, that would be a different story. I don't think there's a question about it now. NDA is coming back. But this is an NDA which is going to be very different from the NDA that we've seen. Right? And there was, prior to the elections, this belief that the NDA would again sweep back to power, and therefore the government could afford not to be populist. Question is that given the election results, even if it's going to be roughly the same set of people in the government, would they continue to hold that stance? And that, I think, is going to be determined maybe in the next couple of days when the NDA partners meet and discuss what their strategy is in the coming months. So I think the level of uncertainty has certainly gone up a lot. And the RBI will have to take that into account.
Fiscal, assumptions the RBI will have to make. But Sonal Varma, let me come to you on the growth issue. 2 days back, the growth question I had in my mind is, will Reserve Bank up the growth forecast? But now my question to you is there a downside risk to the growth forecast?
Yeah, Latha, I don't think there's any need to actually tinker with the growth forecast at this stage. So the 7% RBI has still seems fairly reasonable. We are starting off on a higher base on the back of FY24. There is, I agree, uncertainty in terms of the composition of expenditure we will see in the new government's term. But I think that's still a wait and watch. And broadly, we do think that while there could be some tweaks, the focus on supply side reforms on capex will continue. So I think the fundamentals of the economy still remain the same. The increase that India is going to see because of integration with global value chain remains the same. The drop in inflation we are seeing is a positive for real incomes that should support consumption to some extent in the next 12 months. So I think market reaction has been very adverse, but I think it's a bit too premature to jump the gun.
7% RBI's current forecast need not be disturbed, is your point?
I don't see any reason for that.
Okay. Well, then now let me come to the inflation question. Soumyopkanti, what's your sense about the RBI's inflation forecast? There is, as it is, an issue of potatoes and tomatoes. We just had the Agri-Ministry announcing that there is a shortfall in some of these vegetables. More importantly, there is a chance of a higher fiscal largesse. We don't know if the budget will be similar to what was presented in February. The two allies on which the government is dependent both want a big package for their own states. So do you think that there is an upside risk of fiscal deficit and therefore to inflation?
Yeah, thank you, Latha. I think in terms of your first question, in terms of the upside risk to fiscal deficit, I think the government was, in the interim budget, was working with a fiscal deficit of around 5.1% for next year. And after the RBI dividend, there was a largesse of around 30 to 40 basis points. So my sense is that the government can actually walk a little bit midway. It can reduce the fiscal deficit to show to the market on intent on fiscal consolidation, but may not got the full hog of absorbing the entire amount of the dividend transfer money which it has got. So that will actually satisfy both the market and also open up any space for any fiscal, any largest, I will not call it largest, or any fiscal support which the government may want to unveil. So this is regarding the fiscal deficit. So I still maintain to believe that there will be a gradual path to consolidation, but the consolidation path could be a little more milder than what it was earlier. Now coming to
So 5.1 is what RBI will work
so
with.
basically the RBI may actually work with a deficit of maybe, the government can actually work with a deficit around a little bit lower than 5%, maybe 4.9 to 5%. So that doesn't go the entire distance down to 4.7 or so. So this is the first point. The second point regarding the inflation, as of now, the inflation trajectory for the entire year of fiscal 25 looks that most of the numbers are likely to be stay below 5%. There are two numbers in July and August when the number actually goes closer to 3%, and there actually the RBI, the number which will be available to RBI in the October policy. So that is the time when the RBI could actually take some solace for the inflation trajectory. But as of now, given the current predicaments, the current inflation trajectory, and the current growth path, the 4.5% average inflation which the RBI has forecast, I think the market is also aligned with that forecast. As of now, there may be one or two negative surprises in the summer months, as it happens every year. So I think the RBI will look through that. But as of now, it will maintain that the inflation is on its glide path, possibly not moving to 4% sooner, but at least it will be around 4.5% band for most of the year.
Okay, well, the bond market at the moment is working with the assumption that probably fiscal deficit and maybe therefore inflation likely higher. We have seen a 10 basis point, I think even more, 11 basis point rise in yields after the election results were announced. Samiran, would you want to add to that inflation argument? I mean, is there a possibility of higher MSP announcements, for instance? And the other, my sense, lesser issue, you think liquidity is not an issue for the current MPC or the RBI?
Thanks, Latha. I guess the way to look at it is that the bond markets were getting one tailwind after another for some time. It was first the RBI dividend, then it was the outlook change from S&P to positive, and the markets were prepping for another positive news coming out of the election as well. But unfortunately, that has not played out. So it's basically reversing the down move that happened on the good news and coming back to where it was. I don't think market is right now pricing in any sort of a fiscal slippage and additional borrowing for FY25. And as Shomo was mentioning, there is significant buffer for the government to work with, not only the RBI dividend, but also the fact that FY24 fiscal deficit has now been 5.6 rather than 5.8, means for most of the revenue numbers, the base is much higher. So you could end up with a even lower fiscal deficit or some more space to do both capex as well as some populist spending if the government decides to do. The only challenge seems to be that till you see the budget, there is no clarity on the fiscal glide path over the more medium term. This year is not a problem. The medium term is still a bit uncertain. The other issue is that whatever that populist spending is, or whatever the increase in MSP, in fact, the increase in MSP decision can come much before the budget, would be a signal of whether the government, just like it was very conservative on inflation in the last 5 years, it's maintaining that conservatism or is now going to play a little differently and might allow a bit of price increase to happen just to ensure that the consumption side of the economy, particularly in the rural, also gets a bit of a fillip out of it. Liquidity, I think at this moment, RBI has managed it quite well. In fact, the only concern is that as the new government comes in and spends the whole backlog of last few months with this 2.1 trillion surplus from the RBI in its kitty, would that actually increase liquidity too much? And at some point of time, RBI will have to absorb that. And this will also coincide with the inclusion on the bond index. So to that extent, there could be flows as well. So the RBI might have to swiftly move to the other side to manage the liquidity as we move forward. But for now, it's not a big challenge.
Yeah, time permitting, I'll come back to liquidity. That expected flows may not materialize, which is why I thought liquidity may not be, it may be a non-issue for RBI. But the bigger ecosystem is what I'm forgetting, the global ecosystem. The Fed, many believe, may not move ahead of a US election. That apparently is a tradition there. But Sajjid, tell me, what will the Reserve Bank have to parse in terms of the global environment?
I know we're very focused on the domestic environment, but we shouldn't forget that there are multiple uncertainties that still characterize the global environment. Rates, currencies, commodities. Let me come to each in turn briefly. I think the starting point here for central banks is, this is like the movie Groundhog Day, where every day is the same. Every quarter, we talk about the resilience of the global economy. And this quarter is no different. Again, we have a global economy that's tracking 2.5%. The distribution of growth is now better because it was being led largely by the US. We're seeing European growth pick up. We're seeing growth move from services to manufacturing. So there's an underlying resilience in the global economy that we've been discussing for the last 2 years. That means that central banks are under really no pressure to ease monetary policy rapidly. The complicating factor is that the last mile of disinflation is becoming challenging. Global core inflation in the first half of 2024 was 3.4%, right? 3.4%. So for developed markets whose inflation targets are closer to 2%, there's still a lot of work to be done. Now, this does mean, however, that some central banks are going to move. We've got two important meetings this week, the ECB and the Bank of Canada, and we expect both will ease. But the elephant in the room really is how the Fed moves. Remember, markets started the year thinking there'll be 6 cuts. We're now down to less than 2 cuts. And given the resilience of the economy, if over the next couple of months, core inflation doesn't, soften more meaningfully, that's going to remain an open question. So I think financial conditions globally will be dictated a lot by the Fed, and there's no clarity at all as of now whether the Fed will cut in 2024. Now, the fact that there is this differential easing across the Atlantic also complicates currencies, because if you have a situation where the Bank of Canada is cutting and the ECB is cutting, but the Fed is not cutting, all else equal, that will mean a stronger dollar. And if you have a stronger dollar, that will put pressure on emerging market currencies. And then the third leg of the uncertainty is commodity prices. What's been a welcome relief over the last few days is crude prices have come below 80. But let's not forget, if we step back, what you see is industrial metals have been rising over the last 6 months, where, between 10 to 15% higher than when we started. And if you look closely at the input prices for manufacturing in the PMI that came out yesterday, input prices have moved up quite sharply. So I'll just summarize by saying, there's a lot of global uncertainty related to monetary conditions, currencies, and commodities that the central bank will have to keep a close watch on.
Okay, short point, it doesn't get any dovish signals from the global ecosystem. Okay, I have to take a quick break. On that note, for Bazaar viewers, you will get back to Chartbusters, but I'll continue the conversation with the Citizens Monetary Policy Committee. You will get to know how they are going to vote on the Reserve Bank's interest rate and stance after market hours, that is today evening. Back in a minute. NBC TV 18 Citizens Monetary Policy Committee. I have been speaking with Chairman of our committee, Pronab Sen, and members Sonal, Varma, Samiran Chakrabarty, Sajjid Chinoy, and Soumyopkanti, Ghosh. Gentlemen, and Sonal, thank you very much for your patience and for staying on. Well, I'm going to continue a little bit more with the political backdrop and its likely impact. Dr. Sen, if you have to put yourself in the Reserve Bank's shoes, should it worry that even in future there can be some impinging on inflation? Because like I told you, there are two allies with state-related demands. So do you think that, demand for an Andhra package plus a Bihar package or a Bihar package, etc., is something that the MPC should consider? Is that even something that will figure in their deliberations?
They should certainly consider it, which is why, given that we won't actually know until it happens, it creates a huge amount of uncertainty at the moment. And I'm almost certain that both Bihar and Andhra Pradesh will demand packages, and they're very likely to get it. The question is the type of package and the amount of money that's involved. If, despite that, the government wishes to keep the fiscal deficit under control, they will then have to find savings elsewhere. And it's that series of choices that have to be made which creates the uncertainty.
Okay. Do you expect even things like higher MSP, which is, something that has to be done immediately?
I don't think the MSP is going to be a big shocker.
Okay. All right. That will be some solace for the bond markets. Let me look at the other question of growth and inflation. Sajjid, to you, we are faced with a peculiar situation even in India. It's like fiery growth. If you look at 8.2 overall GDP, or even if you looked at GVA, 7.2 is not a laughable number at all. And yet you are having, very low core inflation. How will the Reserve Bank reconcile the two? Will they be happy that core inflation is going towards 3 and therefore there is a scope to sound dovish?
Thanks, Latha. I think, at the prima facie, this seems like a puzzle that if growth is tracking 8%, how come core inflation has been so soft and the annualized momentum of core has been, 3% or slightly less? But in a way, this should not be a puzzle. If you step back, when you think about the dynamics of core, you think about slack in the economy. And slack in the economy is based on levels, not on growth rates. And so the way to think about this is to say, had there not been a pandemic and India's growth was about 6.5%, potential growth, what would the level of output have been? And notwithstanding, strong growth in India in the last few years, what is the level of output now? And what you find is India is still, though growth has been impressive, India is still, 4 to 5% below that pre-pandemic path. And that is an indication that there is still slack in the economy. The slack is showing up both in capacity utilization, which has been range bound around 74 or 75%, and it's also showing up in the labor market. So given that there is slack and given that slack, there is no pricing power, which is also showing up in the fact that sales growth of earning of companies, is still in single digits in nominal terms. So the combination of there being slack and less pricing power, and the fact that input prices, which were responsible for inflation, in 22, 23, have come off very sharply. If you put those things together, it should be no surprise that there is, that core inflation is where it is. A couple of things to keep in mind, however. Now, prima facie, this by itself would suggest that there is space for policy support if there is slack in the economy, that that should show up in some Taylor rule of the central bank. But there are a couple of caveats here. One is, as I mentioned, input costs have begun to go up. Global goods were disinflating and were in deflation last year. They've begun to turn around. So we'll have to keep a close eye on where input costs move. But secondly, this is where emerging markets face, in a way, the trilemma, because their own economies have more slack, much more slack than the US economy has. And yet, because of the nature of the global capital system, we are de facto importing tighter monetary policy from the US. And so if the Fed doesn't ease, that puts a limit as to how EM central banks can ease.
Okay. So even if there is slack, the Reserve Bank can't do much about it. Samiran, should there be any attention paid to the stance of the policy by the MPC? Do you expect a change? If yes, when? This policy, or will it take time?
But I think this is a classic policy where minimizing volatility in an uncertain environment should be the primary objective of MPC. We just don't know about a lot of things that's going to happen over the few months. the default option for MPC cannot be to take a farm view on either the government will be exactly like it was in the earlier term, or it will be definitely different from the earlier term. None of these two things the MPC probably will know for sure. So, and the markets have been very volatile. So the objective should be to not change things much and keep that impression of stability continuing. It's important that macro and financial stability is maintained regardless of how the political outcome could be, because we have, with a lot of effort over the last few years, gained that macro and financial stability. We would not want to lose that just on the first sign of any shock.
Would you agree, Sonal, that the big task before the Reserve Bank would be to neither sound dovish nor hawkish? Anyway, a more open question. How do you expect them to sound?
Neutral, alert. I think uncertainty is quite high, both with respect to global outlook and risks, but also now domestically in terms of the fiscal path, composition of fiscal, or if there are going to be shifts in rural-related policies. Plus, we don't know how monsoons will play out. So when faced with uncertainty, the best response is to go slow and step back and wait for things to clear out. And I think on growth inflation, we are in a good place. Headline is above target, but core is closer to 3. So it is a wait and watch for now.
Okay. Just a final word on liquidity, Soumyo. We were expecting, bond inflows starting and perhaps, active funds also piggybacking on to the India bond inclusion. We expected that a very stable government would mean equity flows. Now, do you think, liquidity need not be a botheration at all? Or do you think something like MSS or something may yet be hinted by the RBI?
Yeah, Latha, I think that's a fair question. And on the liquidity part, I just want to add a little bit different to Samiran's views. I think the point which to note over here is that in the last from September onwards, there has been a fundamental shift in the government policy in terms of fund transfer. I'm talking about the government cash balances. So the government, I think, has slowly moving towards a just-in-time mechanism of fund transfer for the centrally sponsored schemes, such that the government cash balances have actually moved out of the banks. It is now actually lying with the RBI. So basically what is happening is that provided that you spend funds, I think the amount is around 75% of the funds, then that fund is directly released by the RBI to the states with the matching grant from the center. So my simple point is that the earlier logic of government spending, increasing the cash balance, in the government starts spending, so the liquidity will improve, may not hold true in the current context since it is outside the purview of the banks. So having said that, there is also another uncertainty over here. Given the fact that we are living in a world of uncertainty, there may be some impact also on the fund flows. So in this case, the RBI may have to come with innovative approaches to liquidity management, because on the one hand, you could get temporary permanent fund flows from abroad, but on the other hand, you could also get temporary fund outflows in the form of government cash balances. So you have to match temporary with temporary and permanent with permanent. So in short, the Reserve Bank may have to innovate on liquidity management going forward, because I believe that is going to be the crux of the on the evolving part of the monetary policy in the future, because the central bank has to ensure that liquidity is within comfortable limits and at the same time it doesn't is too much inflationary.
Okay, well, I could assume that the MPC will steer clear of that discussion, not their headache, they might say. But we are out of time and we have to get to the vote. Members, if you all can, tell us how you will vote. The first question, given the uncertain backdrop, what will the Reserve Bank's rate action, MPC's rate action be? Can I start with, Sajjid?
On a hold.
Okay, hold. Soumyo?
Pause.
Pause. Sonal?
Hold.
Hold. Samiran?
Yeah, it's a hold.
Hold. Okay. Dr. Sen, the entire committee is saying no action.
Hold.
Hold, yes, thanks. Let me get to the other one. The stance, any change, Sajjid?
No change. Withdrawal of accommodation.
Withdrawal of accommodation. Soumyo,
No change.
Sonal,
No change.
Samiran.
No change.
Okay, this is not all that perfunctory. Dr. Sen, in the past you have said neutral. What's the stance now?
I continue to think no change simply doesn't make sense now.
Okay, all right.
There is no accommodation to withdraw.
Well, you definitely have one voice in the MPC supporting you. Dr. Varma also believes neutral. He has already dissented. Well, just very quickly, when do you all expect the first rate cut? Sajjid?
Too many known unknowns, but somewhere in the third or fourth quarter of this year.
Okay, so that will be October onwards. Soumyo?
You are in the third quarter of the current fiscal, so from October.
October. Sonal?
October.
Samiran?
October looks more likely now.
Okay, Dr. Sen, would you agree?
Well, yes and no. I would prefer to wait for the full budget to be presented before one takes a call on this.
Okay, so just postpone the decision at this point in time.
Yeah.
Gentlemen and Sonal, thank you very much for joining me in a very rich deliberation of what to expect from the Reserve Bank. Thanks much for watching this special show.
Thank you.
Thank you.
Thank you.
Yeah.